but those expectations are also based, of course. Now, as I see the calculate group results, are based on, which expiration. So we're going here to this expiration date. We can do that custom end date, but we know that we've already locked in the 14th return, the 15th return. So now the 16th is here. And it does look like here you can see the shorter term are the highest potential. But you're trying to do it daily and you're trying to scalp 5 minutes to an hour. I'd prefer to go at least the next day or 2 days out in time, like I said earlier, 2, maybe 3 days out in time. The only reason why I say that was so much news-driven effects going on in the market. We saw the CPI reports come out, or the inflation reports come out. We know sometimes they come out in the afternoon. A lot of times the retail reports, things of that nature will come out in the morning. But when the Fed talks and they make a decision, it comes out in the afternoon. The market could change. So maybe I can scalp in the morning. You can, Raj. I won't be able to, but maybe you can scalp in the morning. But with those kind of news-driven markets, these kind of chaotic markets that we saw before, 5, 6 years ago, and we've seen in other times in the last 4 years as well, leading up to this, but there's a lot of fluctuation going on. Why am I saying 2 to 3 days out? Is because if it doesn't happen in the first day that you expect it to happen, your cost was lower to get in. That balance you asked about price to return. But if it doesn't happen in that first day, this premium might be cut in half. You don't see the movement you want. Maybe try to get a 4%, 5%, 6% return only just to get out with a profit holder. Maybe only a 3, 4, 5% loss, which I guarantee you're probably closing more positions more often and not allowing it enough time, even within an hour, even within a 2-hour period. So one of the reasons why I like to give myself, I would approach it with 2 to 3 days out. If it doesn't happen in the first day, I still have the next day to go, and then I can try to manage. But if you're right, if I'm wrong and I paid $732 for this 2-day out series on January 14th, doesn't do what I want in the first day, and I'm down 15 to 20%, and the next day it opens down, I might be a loss of 50%, or hopefully I might have only lost 12, 15, or 20% on this one before I decided to bail because time was against me. It's a higher cost, but is it double? That's the perfect illustration of what I was trying to talk about earlier. This same day, January 14th, deltas of 0.68 to 0.71, tight range. Not necessarily the same strike, but the same delta. The 579 strike is at 587. The deeper in the money, 578, is at 732 for twice what? The amount of time. Is it at 1174? No, it's at 732. 3 times the amount out in time is 876. Is it at $16, $17? No, it's half of that. It's at 876, even though 3 times the time. Yes, I know the strikes are different, but again, it's the 0.7 delta. You're not doubling the cost by going out here. You have a lower cost per hour, lower cost per day further out. But you want to target what returns you're expecting with these movements. And you see the highest return naturally with a movement that you want, up or down, call or put. That long option finder that I showed you, will also show you put options to buy if you put in a stock price that's below the current price. We put in SPY at 565. That's why we saw the calls to buy. Okay, so it's a slightly higher cost, but we always talk about when we teach the married put approach, discussed in the blueprint for long-term growth protections, guaranteeing you can't lose more than 4, 5, or 6% on any position. Why are we buying 5 or 6 months out in time? Because I'm not paying 5 or 6 times the cost. I have more time for the stock to move in my expected direction to alleviate the volatility of shorter-term market conditions on a stock that I'm still bullish on long-term. But all that being said, scalping, buying, yes, the lower price, the shorter term is going to give you the best return. But when you're thrown for a loop, remember, meaning thrown for a loop what? I entered this on the 14th thinking I was in a bullish move and SPY would move up, which it did, but it actually moved down due to some news that came out globally, inflation-wise, retail sales-wise, economic-wise here in the US, administration-wise, whatever. and it pulled back quickly, in the next hour or 2 hours to about 580. You got to imagine that this might drop 50% of its value. This might drop 33. This might drop 25. That's the balance. Okay, it's gain and loss. You're right. Things go right, the best return is going to be shorter term. Things don't go as you initially expected, the lower percentage losses are going to be further out in time. But they're also going to show you the lowest return. Is there a sweet spot? I'm not clear. I'm not clear with this. This might, a couple of months ago, we were talking, why I mentioned I didn't do 0 days to expiration trading, is someone asked about the 0 days to expiration calendar spreads and the 0 days to expirations credit spreads. And I said, you know what? All right, I'm going to do it. I'm going to go ahead and I'm not going to trade it, but I can't back test it. I can show you what we'd expect with our back testing tools, which are end of day data, but I can't give you a good insight into what is the best approach for a credit spread, debit spread, condor, or something along those lines with 0 day to expiration spreads on SPY or on QQQ. I have to do that in the morning. I have to run a search. We created a search. I have to run a search. On our YouTube channel, we showed on the videos. Let's just take a look here on our videos here. Let's search through those real quick. The 0 day to expiration. I'm sorry. Let's get that correct, shall we? 0 DTE. Let's run that search. And that was 1 year ago, 2 years ago, 6 months ago. 6 and 7 months ago. This is where I was. 0 day to expiration spreads discussion 1 and 2. So I started paper trading these and setting alerts in the portfolio. And at the same time, what I use as my standard default for bull put credit spreads worked out better with a higher probability of return. And at the same time, the weekly bull puts, there we go, the default search there, and was less time to manage. It took too long to manage. And as soon as you have to manage one of those 0 day to expiration spreads, I'm rolling out almost 2 to 3 weeks to get the credit back if I decide to roll out, which I was doing with SPY just to continue it. And the success rate was only about 67, 68%. Now, 6, 7 months ago, was it market conditions? Was it the change in the market? I see all these things come out and say, oh, here's a truck driver that became a multimillionaire, just became a millionaire trading 0 day to expirations in the last 6 months, and that's all he does. And I've seen all those videos. I've seen all those promotions too. So maybe I didn't have my criteria right for SPY. Maybe I didn't have my criteria right for SPX. I was looking at too high of a probability when I should have been looking for lower. I wasn't looking at the right technicals and applying those in. I wasn't applying the right management to close them. Maybe that's it. But it was taking too much time for me personally. Okay, that's where I'm at, Raj. And but some of those discussions you can see here too, related to the 0 day to expirations, how you could set up the search. And I was just more successful with what I was standardly doing. And when the bull put credit spreads went against me, they'd be converted using our pendulum adjustment to a bear put debit spread. That worked for all my positions in the last 3 weeks, or in the last 4 weeks. The ones I had opened before expirations, 3 of the 4 I had opened were converted to bear put debit spreads using the pendulum adjustment. They all ended up profitable where they would have been lost. Okay. All right. Yeah. So he says, I'm making my decision on the DTEs and we'll run some back testing, using losing streak days. Still got work to do. Yeah. It's tough. And it's tough because I couldn't do it with our back. I could give a gauge just like I gave you a gauge, but I can't give 100% accuracy because I don't have the intraday historical data. But I can give you a gauge on what I'd expect to see in my options knowledge, what I've seen, and what we know about those standard options rules that we talked about. That when you're looking at a chain, that the option that's 6 months out in time is not 6 times the cost. In general, when we're buying options, we want to be buying a little bit further out in time. Number one, to give the underlying security more room to move in our desired direction. And number two, because we're paying less of a cost, whether you break it down by hourly, or break it down by monthly or annualized. You're paying a lower cost per hour, lower cost per day. In general, the option that's, again, 3 days out in time is not 3 times the cost of the near term. But your highest returns when you're scalping and you get the movement that you want, Raj, is going to be on the lowest priced option. When we're comparing same deltas, 70 strike, that's obvious. Trade-off. risk and reward, as you mentioned, price to cost, price to risk versus price to profit versus success rate. With what other technicals you're using beyond just using a 0.7 delta, what trends do you decide it's now time to buy a call on SPY, what you're looking for in the background. That all comes into play. And when we're talking about this, we've just sort of discussed in general, I don't want to say a trading plan, but a management approach for this one particular strategy on this one particular security with this one particular section. As you know, and as you're playing around with this, now the stops become important as well. The prices, the exits, the triggers. Raj, at what profit do you close? Whether it's 1 day out, 2 day out, 3 days out, 5 days out, 7 days out. At what loss do you close? 1 day out, 3 days out, 5 days out, 7 days out. That's also going to be levels and little things that you can change because, hey, if I've got 1 day out, I might want to take the 10%, 15% profit, as small as that sounds with a long call, because if I'm starting to see that more often than not, I can get a 10% return quickly in that 5 to 10 minutes. But if I hold it longer than that, I see a 30% loss. That's not going to balance out, is it? What about 3 days out? Oh, it's only an 8% gain at the same time, but the loss wasn't 30%. It was only 15. Oh, that's interesting. Now maybe I have different structures I want to set. And trust me, this is what I've done over the years, playing with numbers. These, as I mentioned, you saw the bull put credit spreads, my preferred search on weekly picks of the day. This concept of the picks of the day originally started with Ernie, who a customer asked him and said, well, you're the expert. A customer, took a coaching session, said, show me what calls to trade. I said, well, you can set up the search any way you want. Here's our preferred techniques. Here's what you do. He's like, well, no, I want you to show me the results. What would you do? What is the preferred search for weekly or monthly covered call? So Ernie did what we just did, Raj, in a much broader scope. He went into the naked put and the covered call search. And he said, okay, I've got all these criteria. Here's where I'd start. How did these perform over an 18 to 15 month period? Now, let me increase the probability. Let me increase the return. Let me look for implied volatility is less than a certain value. Implied volatility is greater than a certain value. Let me include stocks that have earnings between now and expiration. Let me remove stocks that have earnings between now and expiration. And over about 80 to 90 different iterations of different stock, option, and fundamental and technical criteria, this is the criteria over that selected period, and in other tests we've run since then, that came out the best. Either the highest return or the lowest loss in an adverse market. And the same thing was done for covered calls. And I said, you know what? I've been doing this on bull puts. I started trading my technique and developing my technique back in 2016, end of 2016, beginning of 2017. And I started to run tests and I tweaked it. And that's how I came up with my preferred bull put screen for the weekly expirations, looking for the positions with an 85% probability on stocks that have a certain technical and fundamental trend. And it outperformed the other ranges. Why am I looking for something as high as an 85% probability with only a 12, 13, 14% return? I could easily get a 30% return with a 75% probability, because over time, this gets me to the 87, 88, 89% success rate, whereas the 75 with the higher return, even with the higher return, was only a 70, 71, or 72% success rate. And sometimes that loss, even with a 71% success rate, even with triggering losses to stop them at 50% losses, because you're closing them more often. And that's what you might find with the long calls. 3 days out, 5 days out, I might be able to allow a little bit more of negative movement in the stock because I might only be losing 20 or 25%, where the 1 day out or 2 day out option might already be at a 40, 50, or 60% loss. What's my gain on the other side? Is it 20 to 30%? Is it 100% with the 1 day out? Or is it only 20? There's a balance there you got to figure out. That's going to take time. That's the structure. It's not just about opening those. It's not just about doing those and saying, hey, I'm going to scalp and I'm going to close at this point. This point is, what loss can I take whether I'm 1 day out, 2 day out, 3 days out, versus what gains am I expecting? And those triggers are going to be different.